Is Netflix still the king of streaming, or is its stock undervalued in 2026? After a sharp 10% drop following its latest earnings, investors are questioning whether this is a temporary setback or a sign of deeper challenges. With over 325 million subscribers worldwide and bold moves into advertising, sports, and gaming, Netflix's future may hold more surprises than the market expects. Today, we'll break down the numbers, forecasts, and strategies shaping Netflix's valuation in 2026. Netflix is still the world's largest streaming platform, commanding more than 325 million subscribers worldwide. Over the past decade, it has built unmatched brand recognition through original content, global expansion, and a reputation for innovation. From award-winning series to blockbuster films, Netflix has consistently shaped viewing habits and set industry standards. In 2026, the company's scale and subscriber loyalty remain its strongest assets, anchoring its leadership in the streaming industry. Yet, as the market matures, Netflix's identity as a pioneer is being tested by rising costs and intensifying competition. In today's streaming landscape, Netflix is no longer the scrappy disruptor, it's the incumbent. Competitors like Disney+, Amazon Prime, and regional platforms are fighting for market share, forcing Netflix to defend its dominance. The company's advertising tier is now a critical growth engine, projected to generate nearly $3 billion in 2026, with advertiser demand rising more than 70% year-over-year. At the same time, Netflix is expanding into live sports, gaming, and podcasts, aiming to capture audiences across multiple formats. This diversification strengthens its position, but it also raises the stakes: higher costs, tougher competition, and the challenge of proving that Netflix can remain the go-to platform in an increasingly crowded market. In the first quarter of 2026, Netflix reported revenue of $12.25 billion, a solid 16% increase year-over-year. Earnings per share came in at $1.23, well above Wall Street's expectation of 76 cents. Subscriber growth remained steady, with global membership surpassing 325 million accounts. A key boost to results came from a $2.8 billion termination fee tied to the cancelled Warner Bros. Discovery merger, which temporarily lifted profits. Operationally, Netflix continues to benefit from its expanding advertising tier and steady demand for original content, reinforcing its position as a leading global entertainment platform. Despite delivering stronger-than-expected revenue and profit, Netflix's stock fell nearly 9% in extended trading after its Q1 2026 earnings release. The reason wasn't the numbers, it was the outlook. Investors had hoped for more aggressive forward guidance, but Netflix reiterated its existing forecast, signaling steady rather than accelerated growth. This cautious stance, combined with recent U.S. price hikes and intensifying competition, left the market uneasy. In short, Netflix showed solid fundamentals, but the absence of a guidance upgrade raised doubts about whether its growth story is slowing. Now we are looking at a small portion of Netflix's financial statements for fiscal years 2025 and 2024. Looking at Netflix's financials, we begin with gross margin. In fiscal 2025, Netflix achieved a margin of 48.49%, up from 46.06% in 2024. Gross margin shows how much of each dollar of revenue remains after covering the direct costs of producing and delivering content. Put simply, in 2025, from every $100 Netflix earned, about $48 remained after paying for content costs, compared to about $46 the year before. This improvement reflects stronger pricing power and more efficient spending on content, even as competition in streaming continues to intensify. ROIC rose to 28.26% in 2025, from 24.13% in 2024. This means from every $100 of capital invested, Netflix generated about $28 of profit, compared to $24 the year before. For those new to finance, ROIC, or return on invested capital, measures how effectively a company uses the money it has raised from shareholders and lenders to generate profit. In simple terms, it shows how well Netflix is turning its resources into returns. The increase reflects stronger profitability and more efficient use of capital. Next, we look at free cash flow margin. In fiscal 2025, Netflix posted a margin of 21.96%, up from 17.82% in 2024. Free cash flow margin shows how much cash a company actually keeps after paying for operating costs and investments, like producing content or upgrading technology. Put simply, it's the money left over that can be used to pay debt, buy back shares, or reinvest in growth. In 2025, this means from every $100 of revenue, Netflix kept about $22 as free cash flow, compared to only $18 the year before. The improvement reflects stronger subscriber growth, rising advertising revenue, and more disciplined spending. For investors, a higher free cash flow margin signals healthier financial flexibility and resilience. Finally, we look at interest coverage. In fiscal 2025, Netflix's ratio improved to 9.1 times, up from 6.9 times in 2024. Interest coverage shows how many times a company's operating income can pay its interest expenses. The higher the number, the safer the company is in handling debt. For Netflix, this means its profits were strong enough to cover interest costs more than 9 times in 2025, compared to nearly 7 times the year before. The improvement reflects both rising operating income and slightly lower interest expenses, signaling healthier debt management and stronger financial resilience. As Netflix moves through 2026, several positive catalysts are reinforcing its position as a global entertainment leader. International expansion remains a powerful driver, with localized productions such as Korean dramas and region-specific series continuing to attract new audiences and reduce churn. Analysts emphasize that this regional momentum is crucial, as it broadens Netflix's revenue base beyond the mature U.S. market. Another catalyst is the advertising-supported tier, which has quickly become a growth engine. Advertisers are eager to reach Netflix's vast audience, while cost-conscious consumers find the lower-priced option appealing. This model not only diversifies revenue streams but also strengthens Netflix's competitive edge in an increasingly crowded market. Diversification into live sports, interactive gaming, and podcasts is also reshaping Netflix's identity. By expanding beyond traditional streaming, the company is building a wider entertainment ecosystem that increases user engagement and positions Netflix as a one-stop destination for varied formats. Underlying all of these developments is stronger cash generation and operational discipline. After years of skepticism during the streaming wars, Netflix has demonstrated its ability to produce consistent free cash flow. This financial strength provides the flexibility to invest in new content, technology, and shareholder returns, ensuring that the company can sustain innovation while maintaining balance sheet health. Together, these catalysts, global expansion, advertising growth, diversification, and cash flow resilience, form a narrative of a company that is not only adapting to industry shifts but actively shaping the future of entertainment. While Netflix enters 2026 with strong momentum, several risks could undermine its trajectory. Rising content costs continue to pressure margins, and although price increases help offset spending, they risk pushing subscribers toward competitors. Regulatory challenges are also mounting, from antitrust concerns to tax liabilities in key markets, creating uncertainty around global expansion. Investor sentiment remains fragile, with Netflix's stock historically prone to sharp corrections when growth expectations fall short. At the same time, competition in streaming is intensifying, and the advertising tier, though promising, has yet to prove its long-term profitability. Together, these factors remind us that Netflix's path forward, while promising, is not without significant challenges. Now we are looking at Netflix's stock valuation, where its fair value is estimated at around $103.69. On April 17, 2026, Netflix shares closed down nearly 10%, triggered by the outlook released by the company, which many investors viewed as too pessimistic. Nevertheless, from a fundamental perspective, Netflix's business performance remains relatively solid. Be cautious of a potential technical rebound, as Netflix shares are currently considered relatively undervalued. Investors are advised to act wisely in making decisions. This content is for educational purposes only and does not represent financial advice. Thank you for watching, and don't forget to like and subscribe for more insights.